Good morning, everyone. We will be the second reporter and will be tackled estimating risk and return on assets, which is chapter 22. Reporters, me, Ivy Concepcion Duaman, Aramiko Tanda, Miraflor Totor, Sharmina Sorda, and Gina Digan. Estimating risk and return on asset. Para ninyo, unsay pasabotan niya? Pagbana-bana sa risko ug pagbalik sa imong mga kabtangan. So mao na ang estimating risk and return on assets. Introduction. In Chapter 1, the primary goal of the firm and therefore its financial managers is stated to be shareholder wealth, maximize the price of the firm's equity shares or common stock, given legal and other constraints. Each of these financial decisions has certain risk-return characteristics that affect share prices. This chapter explores the meaning of risk and return and how they can be measured. So, basic risk and return concept. Risk is the variability of an asset's future return. Risk refers also to the chance that some unfavorable event will occur. So, basic risk and return concept is the concept states that an increased probability for return is highly correlated with the increase in the level of risk taken. In theory, an investor could expect higher return on investment only if willing to accept a higher level of risk. So, example, kay bank account, it's guaranteed by the government, so there is almost nga way chance nga you will lose your investment. Risk return relationship. Investment risk then related to the probability of actually earning less than the expected return. The greater the chance of low or negative returns, the riskier the investment. Very low risk investment also provide a very low return. Risk-return relationship enables you to reduce the risk of your portfolio with sacrificing potential returns. Once your portfolio has been fully diversified, you have to take on additional risk to earn higher potential return on your portfolio. So, dapat mo sacrifice jud ka para mabalik ang imong kita or hinaguan. So, once gani nga fully diversified, kailangan jud nga mo take on additional risk para maka-earn kag higher potential returns sa imong portfolio. So, na siya, kailangan jud nga mo sacrifice jud ka para mabalik ang imong nasugnan. Mao na ang risk-return relationship. Taking risks also means that the investors does not get a guarantee that the investment will be recouped. So, from the word recoup is mabawi. In addition, not all funds are rewarded. So, bahalag way kasiguraduhan nga dili mabawi basta kay you taking risk. That's all. Thank you.
Good morning everyone, especially to our instructor, Mrs. Josephine Andrea Auxilio. Good morning, ma'am. I am the second reporter. I'm Aramiko Tanda. I am the one who will continue the topic of Miss Ivy Duaman. And the topic I will discuss now was a probability and probability distribution. So, probability is the percentage chance that an event will occur. Probabilities range between 0 and 1.0. Just like, for example, a senatorial candidate states, there is a 40% chance that I will lose the election and a 60% chance that I shall win. So, if all possible events or outcomes are listed and the probabilities assigned to each event, the listing is called a probability distribution. So in this example, the election forecast, the following probability distribution could be set up. So if you have already the book, can you please turn the page into 552? And as what you can see in the books, the probability distribution could be set up like as what you can see there, the outcome and the probability. That's how it is going to be set up. So a probability distribution may be objective or subjective. So what is objective probability and subjective probability distribution? So objective probability distribution is generally based on past outcomes of similar events. From the word itself, past. So past, it is the probability where an event occur based on analysis, based also on a recorded observation and long history of collected data. Then subjective probability distribution is based on opinions or educated guesses. So it will going to allows the observer to gain insight by referencing things they've learned and their own experience. So in short, personal judgment. This is subjective probability. Next, a probability distribution is also maybe discrete or continuous. So what is discrete and continuous? A discrete distribution is an arrangement of the probabilities associated with the values of a variable that can assume a limited or finite number or values or outcome. So, how do we know if a probability distribution is discrete? So, man nato pagkaibaw. So, a random variable is discrete. Itawag ni siya discrete if it has a finite number of possible outcomes or countable number. The integers are infinite but are able to be counted. Second is a continuous probability distribution. It is an arrangement of probabilities with the values of a variable that can assume an infinite number of possible values or outcomes. So kindly please turn the page into 554. As you can see, there is an illustration there or an example. To illustrate, assume that two investment prospects are available to Mr. Martin who has 100,000 pesos in investable funds. He is considering the following. Sa A, investment in XOR Products Incorporation, a manufacturer and distributor of computer terminals and equipment for a rapidly growing data transmission industry. Or B, investment in Zamboanga Electric Company which supplies an essential service. The rate of return probability distribution for the two companies are as follows. So naman mo libro no, palihog lang kong tanaw. So, the above tables are known as payoff matrix. We can graph the rates of return to obtain a picture of the variability of possible outcomes. The height of each bar signifies the probability that a given outcome will occur. The range of probability returns for XOR products is from 100 to 70% with an expected return of 15%. So the expected return for Zamboanga Electric is also 15%, but its range is much narrower. Next, turn your page into 555. Makita man nyo ang graphing. This is what we call the expected portfolio returns. The expected portfolio return is the weighted average of the expected returns from the individual assets in the portfolio. And makita po diha ang formula sa expected portfolio return. So, how are we going to calculate the expected return on a portfolio? So, using the formula, The expected return of a portfolio is calculated by multiplying the weight of each asset by its expected return and adding the values of each investment. That's how are we going to calculate the expected return on a portfolio. That's all, and thank you for listening. And the next reporter is Miraflor Tutor.
Standard deviation. Standard deviation is pronounced as sigma, is a statistical measure of the variability of a probability distribution around its expected value. The standard deviation can be used as a measure of the amount of absolute risk associated with an outcome. Absolute risk does not consider the relationship of the variability of outcomes to its expected value. Standard deviation also measures the tightness of a probability distribution. So, meaning the standard deviation is a measure of the amount of variation or dispersion of a set of values. So, a low standard deviation indicates that the values tend to be close to the mean of the set. So, while a high standard deviation indicates that the values are spread out over a wider range. So next, a symmetrical distribution is one in which each half of the distribution is a mirror image of the other half. So what is symmetrical distribution, by the way? A symmetrical distribution occurs with the values of variables appear at regular frequencies, and often the mean, median, and mode all occur at the same point. So if a line were drawn dissecting the middle of the graph, so it would reveal two sides that mirror one another. A skewed distribution. A skewed distribution is a distribution which is not symmetric. When comparing different investments using standard deviation, the size of the initial investments and the expected value of their probability distribution should also be equal in order to making meaningful risk comparisons. Unless these conditions are met, use of the standard deviation may be misleading. So, skewed distribution. This distribution is said to be skewed when the data points cluster more towards one side of the scale than the other, so creating a curve that is not symmetrical. So in other words, the right and the left side of the distribution are shaped differently from each other.
Good morning. So I will continue the report. So my topic is all about coefficient of variation. So what is coefficient of variation? Coefficient variation is the standard deviation. This formula is applied to normalize the standard of deviation so that it can be evaluated. So generally, ACV equals 1 indicates high variation and ACV1 indicates low variation. So the greater the distance from 1 is in either direction is significant. So, example, imagine that the population of a particular city has an average monthly income of $5,000. So we might assume, based upon the mean, that the average citizen in the city is doing financially well. So as data analysis, however, we know that before we can make a reasonable assumption, so it is necessary to order to determine how uniformly. So the income is distributed among the population. So by calculating the variation of the data set. So portfolio risk. So portfolio risk is the variability of returns of the portfolio as a whole. The richness of a portfolio may be less than the richness of any individual assets. So contained in the portfolio because of the diversification. So diversification is investing in more than one type of asset in order to reduce risk. So it could also be investment in several different assets of the same, but this would be less affected. So Portfolio rest is the amount of your overall portfolio so that you are comfortable having a rest at any time. So, example, you have a total portfolio of $25,000 and you are willing to have 20% or $5,000 at rest. So, double tap to add title. So, a probability distribution may be discrete or continuous. So, a discrete distribution is arrangement of the probabilities associated with the values of a variable that can assume limited or finite number of values. So, discrete distribution can be shown as a frequency table or histogram. So, mga siya. So, diabetes status probable. So, normal. So, 0.56. Pre-diabetes, yes, may example. So, for continuous distribution, they are described in the same way a discrete or categorical variable. So, that's all. Thank you.
Rec preferences. Decision maker want to compensate for the risks associated with an investment. The greater the risks, the more the demanded return. So, kung taas day ang kuan, kung higher or greater, daghan, so more ang demanded the more demanded returns, daghan mabalik. The actual amount of compensations demanded, which is called the required rate of return. So, nadepoy require nga kantidad imuhang ibalik. This is influenced by the individual decision maker attitudes toward risks. Those decision makers have different require rates of return for the same investment because their risk preference different. So, decision makers na kalain-lain nga gi-require unsaon pagbalik or sa iyang gipang invest because sa ang risk preference na pagkalahi na lahi-lahi ba. So, decision maker may be classified into one of the following groups. So, ang decision maker na classify ba giklaro. May klaro nga usa nga grupo. So, kaning tulo mao ni siya grupo sa decision makers. 1. Risk averse. Investors are those that require high rates of return on higher risk security. They are unwilling to pay an amount as much as the expected value of uncertain investment. Risk neutral decision maker are willing to pay and expect value. So, ang risk neutral decision makers, so, willing siya mobayad sa gi-expect nga value. So, gi-expect siya agbaylo nga 20,000 for example. So, means kana nga kantidara willing siya mo bayad ana nga kantidad. Risk takers investors are willing to pay more than the expect value. So, ang risk takers investors are willing to pay more than expect. So, ang gi-expect nimo 20,000 for example. So, ang gipa-invest nimo is 30,000. So, more than pa sa imong gi-expect. So, manay risk takers investors. Risk the return of portfolio. Until this point, risk return analysis is focused on both a single asset of portfolio or collection of two or more assets. Portfolio theory involves the selection of efficient portfolios. An efficient portfolio provides the highest return for a given level of risk or the less risk for a given level of return, while portfolio theory originated in the context of financial assets such as investment in equity share. The generally accept also apply to physical assets such as capital budgeting project. So that's all. Thank you.